Short disclaimer. Kingsland Investments is a registered investment advisor and provides asset management services for its clients. Any public stock mentioned in today's discussion should not be considered a recommendation to buy or sell stocks now or in the future. Our opinions are subject to change and should not be relied upon. Past performance is not indicative of future results. There can be no assurance that any trends described will continue or will not reverse. Please see our full disclosure at kingslandgrowth.com. Terrific. Great. So I'm going to start with the presentation. And from there, we will go into any questions that you may have. You can also email me separately. I also put in a link in the chat to connect to my calendar if you would like to have a follow-on meeting. But we will start with the prepared presentation. We'll be discussing the markets, tariffs, and the economy. We are at a new stage in our economy with the proposed tariffs, and there will be a digestion period. So we will start. You can see that there was a lot of excitement about the potential for deregulation and increased business investment when Donald Trump was elected president. That carried through the beginning of the year. And then it became clear that tariffs were going to come before anything else, as was the beginning of cost cutting with Doge. And the market started to sink. And then on the announcement of Liberation Day, April 2nd, it became clear that the tariffs were vastly harsher than the market thought. And the immediate reaction was sell everything. And in fact, that's exactly what we experienced. This is the way corrections go. They always start with sell everything, and then let's figure out what is actually happening. Now, tariffs don't have a positive history. They're generally used to protect markets, and the impact is a stifling of both innovation and growth. Free trade, on the other hand, has led to mutual growth and prosperity. And the free trade that took place after World War II was unlike anything the world had ever seen, and it ushered in 70 years of the greatest growth the world had ever seen. That could be coming to an end. So let's talk about some of the tariffs in the past. Japan was protecting its electronics industry in the 80s and 90s. That led to stagnation for them. And then when there were product changes, they couldn't keep up. And they were left to old products that nobody uses anymore, such as the Walkman. There have been emerging markets such as Brazil and India that have had high tariff regimes. That has led to slower growth than people would have expected out of them. The US, its history is we had high tariffs in the 1800s and early 1900s. But then after World War II, we moved to close to zero. Part of the appeal of free trade is, of course, you're much less likely to go to war with someone you are have a great trading relationship with. And that's something that we probably don't appreciate as much, given that that was one of the reasons that we ushered it in after World War II. But we have had the greatest period of prosperity in the world with free trade at the end of World War II. So the proposed new tariff regime will put us at a level in which tariffs are higher than they were in over 100 years. Ultimately, this will act as a tax to consumers and could lead to stagflation, where the price of goods goes up but the growth of the economy slows, and that's what the market is preparing for. The immediate response from many of our friends is to sell the United States. Europeans and other international investors accounted for about 30% of US stock ownership. And you can see that they began dumping stocks early this year. This is a great quote from Barron's. The sell-off in bonds, which move inversely to yields, amounts to a decline in the confidence in the US itself. Certainly not what we would want to hear from Barron's, really from anybody. The fundamental picture is also changing. International tourists are starting to not come to the United States. You're seeing that in March, there was a 17% decline, and it's poised to be even worse. Some parts of Maine attract a lot of Canadians, and they're seeing bookings down 50%. So this will be an immediate negative impact to the US economy. The greatest danger we face is that instead of America first, it is America alone. And the Prime Minister of Singapore had a great speech discussing tariffs, and here's some highlights. Protectionism is already bad. Unstable protectionism is even worse. Businesses are holding back, concerned that changing rules will leave them with stranded assets. The US may have turned protectionist, but the rest of the world does not need to follow the same path. We will hold our ground as a beacon of stability, purpose, and hope. And just with that in mind, we are beginning to see some connections across the globe that doesn't include the United States we hadn't seen before. Canada is now openly discussing directly shipping natural gas and oil to Asia. Europe and China seem to be holding their own discussions as well. So this is the true ultimate danger that we are going to be facing. The other question is, well, what exactly are we doing here? Why is it important to move low margin, capital intensive businesses back to the United States? Here's a great quote from Scott Galloway, professor at New York University. 80% of Americans think we need more manufacturing jobs, but only 20% actually want them. What American industry has done was really made a lot of sense. Apple is a great example. The vast majority of the iPhone, about 85%, is from labor in the United States. Design, software, these are high-paying jobs. The average worker makes $200,000 in the United States, and the assembly part, which requires very little skill, is very tedious, very difficult, is taking place in India and China, where the workers make $500 a week. I don't think there's a lot of Americans who want to be screwing in iPhone components for $500 a week. In fact, we know that's just not the case. So this puts some questions into what the strategy is. We don't know what's going to happen, but we do know that when there is change, it usually takes months to digest. The Trump administration dialed back initially. They have a 90-day pause with most tariff increases to begin negotiations. I think they realized that this was too big of an endeavor, and it may not have the right incentives that was originally viewed. There will be, in fact, inefficiencies created from these tariffs, which are a tax. And of course, moving in low-cost manufacturing will add to inflation and reduce quality. And why would quality fall? Because if you are trying to increase margins, you have very high labor, you may substitute lower materials and other things, make devices much simpler, less functionality. So that's a big risk here. We believe that there could be less demand for U.S. services. We actually have 75% of our economy is service-based. We are selling these services around the world. It includes legal, banking, consulting. Of course, software is considered service. All of this, we dominate globally, and there could be a retaliation against that. But ultimately, with the current proposed tariff regime, we're looking at a period in which there'll be slower growth and higher inflation that could last for years. And as a result, stock multiples will likely fall. So let's look at the time period we may be looking at. The tech wreck, this was really probably the best period of stock market expansion we've ever seen. So it makes sense that it took some time to unwind. It took a little more than 2 years. The great financial crisis was about 18 months. That, of course, we were concerned about the next Great Depression. And the Federal Reserve worked with other countries and stabilized things, and we're able to recover in time. COVID was very short, and there was an immediate response by both the federal government, cutting checks for people who were out of work, and the Federal Reserve. They both were pumping liquidity into the economy, which halted the what could have been a very severe drop in the stock market. And now we have this, the reshaping of global trade. We say it started in February 2025. How long will it last? We think it will last months, but as everything, corrections have a pattern, and we will walk you through that. This is different than every other bear market we've encountered because it is entirely self-created. Therefore, the time period and the severity of it are unknown. We can't measure any of this until we actually know what we're dealing with. The market is beginning to assess the changes to the economy, and every corporate leader is going to state their assessment when they report earnings, which began last week. Interestingly, the banks said there wasn't much change. The airlines are suggesting they're starting to see weakness, as are some of the transport companies. And then Netflix reported last night, and they said no change. So not everyone is going to be affected equally. We're first going to have these corporate leaders set the stage for what they think is going to happen in the future. And then when the second quarter reported this summer, that's when I think we'll see the next level of differentiation. Many companies will prove their initial assessment correct, and the stocks will start to recover, and others will prove not correct, and the stocks may go lower. There are obvious companies that are more impacted than others, such as Apple, such as Tesla. And there are many that, like Netflix, may not be affected at all. But we think that the market will be assessing this over the next couple of quarters. And during this time, new leadership will emerge. These are companies that may, in fact, not only are they not going to get hurt, but they actually might benefit. And this is where we're spending our time. Who could be potential beneficiaries? Our portfolios generally focus on companies that are decreasing costs, increasing efficiency, which is a great way to solve for the increased cost and decreased efficiency that you get with tariffs. So we're looking for signs that some of these companies are in fact could be beneficiaries of this new environment. Now, at any time, if there is an elimination of tariffs, we could have a quick market recovery. Could this happen? It could. It's hard to get into the minds of President Trump, but anything is possible, I think. We know that the last 5 years have been absolutely terrific for the Magnificent Seven and really not nearly as great for everything else. We knew that there was way too much money moving into the Magnificent Seven. It should provide an opportunity for other companies. And so we updated this as of the end of the first quarter. We can see that everything fell, but the Magnificent Seven still has appreciated 472% compared to their business growth of 266% over the last 5 years. That compares to the large cap growth portfolio, sustainable growth, that only appreciated up 110%, even though the companies grew 540%. And small cap was just utterly forgotten. 24% appreciation after 472% growth. We think that as people sell out of the Magnificent Seven, they're going to be allocating money into these other areas, which already produced great growth. Their businesses are much larger. The stocks just haven't reflected it, and we think that will happen. The portfolios are well positioned for the short and the long term because they emphasize an increased efficiency at low cost. There's several positive things that are going for these companies. First, their growth remains robust. At the end of the fourth quarter, the average stock believed that they could grow 20% this year with a mid-single digit operating margin improvement. That's a very good starting point. So even if that revenue growth isn't as robust, it will still be double digit, which will be very favorable compared to most of the rest of the market. The valuations are now actually at historical lows, something that we haven't seen, and it is because everybody sold their Magnificent Seven stocks to buy, or they sold everything else to buy Magnificent Seven. We think that could reverse. And of course, the balance sheets of these companies are very strong. In fact, in our small cap portfolio, the average company has 11% of their market cap is in cash, no debt, 11% cash. In fact, some of them have 35 to 45% of the market cap is currently cash in the bank, which we think is offers, you're not going to have a lot of downside when that is the case. So not a lot of downside, good growth. You just need the market to recognize these, and we think that we should have a very good outcome. This has always been our focus. Companies that are producing great revenue growth because the products and service that they're offering are materially better than what they're replacing. They all decided to focus not on just revenue growth, but on profitability after the 2022 increase in interest rates. And that profitability growth is starting to show through. And we think that this will be a very good scenario moving forward. Here, software as a service companies, the cloud software providers, are a proxy for how these great growth companies behave. You can see that they had a valuation problem in 2001, which the market took out. Now their valuation problem is on the other side. It's at the lowest level we've actually seen in their entire history. While their businesses are proven, they're incredibly profitable, we think this this means there's just not going to be a lot of downside from where we are today. It's hard to say what the future will hold, but we do know what to look for from the past. And I'll give you two examples. These were both in the financial crisis. And what's important to appreciate is that the financial crisis market bottom was March of 2009. Here we see Netflix. Netflix bottomed 6 months before the bottom in the market. Why? Because their business was growing quite robustly, and they were actually benefiting from people pulling back on spending. By the time we hit the market bottom, they were well on their way to making a new high, and then they did. Green Mountain Coffee Roasters, an even more dramatic story, similar. They bottomed in the fall. They had just started introducing the Keurig personal coffee makers, and people loved it. It was very convenient, tastes great, much lower cost than Starbucks, and people were looking for lower cost. And in fact, during the Great Depression, the Great Recession, they were able to find themselves moving to new highs. And when the market bottomed, the stock made a 60% move in just a few months. So really quite dramatic. And this is, of course, what we are looking for. We are looking for the next leadership. It's going to be companies that are not only not being impacted by the tariffs, but may in fact be beneficiaries as companies are looking to reduce costs and increase efficiencies where they can when they have to incorporate the impact of tariffs. Here is a snapshot of the three major strategies that we offer. You may have one of these, or you may have a combination of some of them. We do, of course, personalize some portfolios for specific needs, but they all have something in common, which is they don't have a ton of positions. They're more concentrated. We're very focused on finding great businesses that we think are going to get a lot larger over time. They tend to have higher revenue growth than most than the average mature business. They also tend to have higher operating margins. We don't like capital-intensive businesses. We like companies that can grow nicely without a lot of capital expenditure. They also tend to not have a lot of debt. Now, on the balanced growth side, there is a little bit more debt because these mature companies are trying to use the debt markets to have better earnings growth. And so, even Microsoft and Apple have debt balances. Turnover generally has been low because we are focused on finding great companies and holding them as long as they remain what we originally thought they would at the time of investment. This turnover has increased a little bit because we are in a new market environment, and some of the fundamentals of these companies have changed, and we are changing to accommodate the portfolios to make sure that we remain in the best-in-class businesses. Here is a snapshot of what we owned in each of these portfolios. And of course, the long-term growth, most of these companies are not well known, but you'll see there's a number of healthcare companies. Their businesses will probably not be affected at all. In fact, Blueprint, Guardant, both have new products. Blueprint has a cure for mast cell immune deficiency disorders, and they're growing very robustly. Guardant Health just introduced a blood test for colon cancer. First of a kind. It's never happened before. And in fact, 40% of people have no way of detecting colon cancer because they don't want to get a colonoscopy, and now they can get a blood test. So we think that this is a very strong portfolio, and we think it's going to perform well. Sustainable growth, of course, many recognizable names, some are less recognizable. We feel very strongly about this. And then, of course, the balanced growth. A lot of the larger positions are dividend payers. We will see some of these great companies smaller down in the portfolio. But that is the presentation. I'm now going to see if there are any questions out there. You can either put something in the chat or Q&A. I have never done this before, so I must say that I may not get it right the first time, but we'll see. So I'd love to see if there are any questions out there. You can always just reach out to me directly as well. All right, we have a question. On page 12, you noted revenue growth. How do you think about earnings growth? So in general, we're going to see both revenue and profit growth of most companies is going to be challenged. And the reason it's going to be challenged is because tariffs are going to create greater inefficiencies. Now, if you are a company that is early in your maturation cycle, you are growing so fast that you don't need to spend as much to see operating profit expansion. We saw that when Netflix reported last night, that in fact happened. They don't need, they're putting out something every week. They don't need to put out 3 movies a week. One is just plenty. And because of that, they're seeing natural operating leverage. So there will be plenty of companies that can still grow their profits during this time. And of course, that's what we'll be looking for. Any other questions out there? If not, we will make this available. Oh, we got another one. During times of recession, I've heard the defensive sector is a good place to put your money. What are your thoughts? Well, the starting point is very important, and defensive sectors typically include healthcare, which we have a new regime, which is going to make some winners and losers that are different than what we had thought. Utilities are typically defensive, as are consumer staples. Utilities, they probably will continue to be defensive. And staples are not going to be as defensive because they had, in general, put in huge price increases to the point where new price increases are leading to drops in volume, which is not good for them. So even though consumer staples have done well since the beginning of the year, they're going to face a challenge because of that. And that looks like the end of the questions. I thank you for your time. Thank you for attending this. We plan to have more of these, and we would love your feedback. So please let me know what you think of this. Otherwise, have a great rest of your day. Have a great weekend. Happy Easter for all those who celebrate. And we look forward to seeing you next time. Have a great day.